Tokenization 2026, From Hype to Financial Infrastructure. For years, tokenization was treated like an experiment, proofs of concept, sandbox pilots, interesting demos that never quite left the lab. But 2026 is different. This is the year tokenization stops being discussed as a future idea and starts operating as real financial infrastructure, not speculation, not hype cycles, but real assets, real institutions, and real capital moving on programmable rails. So today, let's break down what tokenization actually looks like in 2026 and why this shift matters far more than most people realize. The big shift from pilots to production. Up until now, most tokenization projects sat in a strange middle ground. They worked technically, but they didn't fit cleanly into existing financial systems. That changes in 2026. Banks, asset managers, and funds are no longer testing tokenization. They're deploying it where it solves clear operational problems: settlement speed, reconciliation, reporting, and access. Tokenization in 2026 isn't about replacing finance. It's about upgrading how finance moves. Instead of T+2 or T+3 settlement, assets can move near instantly. Instead of fragmented registries, ownership lives on a single source of truth. Instead of manual compliance checks, rules are enforced directly at the asset level. That's the real breakthrough. One of the biggest misconceptions is that tokenization means chaos or a lack of oversight. In reality, it's the opposite. Modern tokenized systems use identity-aware wallets. That means investors are verified before they ever interact with an asset. Jurisdiction, accreditation status, transfer limits, all enforced automatically. Smart contracts don't remove rules. They encode them. This is why institutions are finally comfortable adopting tokenization. Compliance isn't bolted on after the fact. It's embedded from the start. And importantly, most of this happens on permissioned or hybrid blockchain infrastructure, not open, anonymous markets. Speed and transparency without regulatory shortcuts. So where is tokenization actually happening in 2026? First, tokenized treasuries and money market funds. These assets are ideal. Simple cash flows, massive demand, and huge efficiency gains from faster settlement and broader distribution. Second, deposit tokens and on-chain cash equivalents. These allow banks to move regulated money on blockchain rails for settlement, payouts, and internal liquidity without relying on unregulated stablecoins. Third, fund tokenization. Private funds, credit funds, and alternative vehicles are increasingly issued as on-chain interests, simplifying subscriptions, redemptions, and reporting. And finally, real estate, not flashy JPEG deeds, but structured exposure to income, NAV, or specific tranches. Fractional access, clearer ownership records, and programmable distribution of returns. This is tokenization done quietly and correctly. The real impact of tokenization isn't speed alone, it's composability. When assets live on programmable rails, they can interact with other systems automatically. Reporting becomes real-time, risk becomes more visible, liquidity becomes more precise, not more chaotic. For investors, this means broader access and cleaner exposure. For institutions, it means operational efficiency, what some call operational alpha. And for markets as a whole, it means fewer frictions hiding in the plumbing. Now, let's be clear, this isn't a utopia. Secondary liquidity for tokenized assets is still controlled and measured. Regulation remains jurisdiction-specific and uneven. Data standards are improving, but not universal. Tokenization doesn't magically remove risk. What it does remove is unnecessary friction, and that distinction is crucial. So if you take one thing away from this, let it be this. Tokenization in 2026 is no longer about disruption. It's about integration. It doesn't replace banks. It upgrades how banks operate. It doesn't eliminate regulation. It makes compliance programmable. And it doesn't promise overnight liquidity. It delivers long-term efficiency. This is what financial infrastructure evolution actually looks like. Quiet, deliberate, and inevitable. If you want to understand where capital is really heading next, this is the layer to watch. If you found this useful, subscribe to the channel for weekly breakdowns on tokenized real assets, fractional ownership, and the future of programmable finance. And drop a comment below. Which asset do you think benefits most from tokenization next? Real estate, credit, or something else entirely?